Hi everybody, welcome back to another video. Recently, the market has been very volatile, especially for the US office REITs. If you have been following my previous videos on the three US office REITs, which is Keppel, Pacific Oak US Reit, Prime US Reit, and Manulife US Reit, if you see from the start of November till now, they have huge increases in their share prices. With Keppel Pacific Oak increased by 70%, Prime US Reit increased by 100%, whilst Manulife also increased by about 100%. So in this video, we'll go through what are the external factors that is actually affecting it and whether any fundamentals are improving in the respective REITs. If you have been following the stock market closely, there has been sharp rises in the share prices due to one main reason, and that is the better results from the CPI data. So for those who are new to this CPI data, it's essentially the inflation data that is produced every month by the US government. Similarly, Singapore also has one, but to be honest, Singapore doesn't affect that much as compared to the US CPI data, because as CPI data improves, the risk of interest rate increasing decreases. Now if you look at this chart, for their 1 month change in CPI seasonally adjusted since October of 2022 to October of 2023, it has come in at a new low of just 0.0%. So essentially, month over month, there is 0% increase in the inflation. So this is a very good news, especially for the US market, because if Fed changes the rate, Singapore banks will increase the rate and they'll directly affect all the REITs. So therefore, having a very low CPI data essentially means that the Federal Reserve in the US will not increase rates and would rather have a higher odds of decreasing in the next year. Another reason is that the CPI index came in lower than expected. So usually analysts would have expected CPI data every month. So if you can see from the CPI core, expected was 0.3% month over month, while 4.1% year over year. But actual came in at 0.2% month over month, while 4% year over year. Similarly, for CPI, it came in at 3.3% expected, but actual came in at 3.2%. So it's essentially 0.1% lower than expected, and that is great news. So because REITs runs majority on debts, and if interest rate drops, REITs will definitely perform better because their loans will be cheaper and they will be easier to operate. Before I continue my video, I would like to share one of the new brokers that I'm using in the US market trading, and that is Webull. Webull is a low commission based broker used by popular users or YouTubers such as Kevin. Now, for the remaining month of November, they give an amazing promotion when you sign up with my link today. You can get at least USD $100 to $5,000 worth of free shares when you deposit any amount and leave it inside for 30 days. Moreover, they also provide 31 days of commission free for US trading. So Webull also have another promotion, which is their Moneybull. So Moneybull is an area where you can use your idle cash to subscribe to funds, and that will allow you to earn daily interest and even earn stock vouchers now because of the promo. So now deposit at least 3,000 USD onwards will earn you additional cash vouchers on top of the daily interest that you will earn. So sign up today on my link to open your Webull account today. So let's get right back into the analysis. Next, let us look at the Q3 of the JLL US report. So if you are new to this report, it essentially talks about the US offices environment and how it's performing. So as you can see from the executive summary, they have also mentioned about the recent CPI data, with CPI actually reaching 3.6% in August, which is actually already the lowest since October of 2021. So imagine the October data that came in was even way lower as compared to the August data. So there's mixture of information where leasing actually fell by 4.2% quarter over quarter, but still outperformed Q1 large-scale leasing, which is still an improvement year over year. Absorption rate of US offices is still at the negative of 18.3 million square feet in Q3, whereas vacancy increases because of the negative absorption rate. However, asking rent has increased by 0.5% quarter over quarter due to a higher quality in the new offices that is available. Focusing on the different parts of the report, you can see for the newly effective return to office mandates, they have seen an increase in the amount of companies announcing of return to office that is required. Because in my opinion, I feel that return to office is definitely a more efficient when it comes to working. In my previous video, I've talked about how the big techs or the big 7 companies have been asking employees to go back to offices. Smaller companies would definitely observe the high-tech companies and actually follow on by it. So in this month, companies like Zoom and IBM have issued attendance requirement during the Q3. Other companies are also implementing a hybrid office where employees are required to come back to office at least 3 to 4 days a week while having a 1-day work from home. So this is a good thing, especially for office REITs, because this means that companies would still need the office spaces, and the demand might increase as the companies improves in the economy as well. Another positive takeaway from the JLL report is that the US active tenant requirement volume has increased for both gateway and secondary markets, where gateway markets increased by 3% while secondary markets increased by 8%. So what does this improve in active tenant requirement volumes mean? So if you can see here, typically increase in active requirements precedes an acceleration of leasing volume by 2 to 3 quarters. So this actually meant that in the next 2 to 3 quarters, there might be a higher demand in the leasing tenants. So this is good news for all REITs, because this would mean that they will be able to get more tenants at a higher rate and a higher rental price possibly as well. Of course, it's also important to take note on which region that is actually improving at a higher rate, and that is the secondary market. So what are the difference between these two markets? So gateway markets are essentially places or states which has a lot of population, and it is essentially the business areas such as New York, LA, San Francisco, Boston, DC, and Miami. Secondary markets have similarities to gateway cities, but because they are not as popular, that's why they are called secondary markets, or another way of calling it, they are non-gateway cities. However, these cities are usually have a higher growth as compared to the gateway cities. Therefore, states such as Colorado, Denver, Atlanta, Seattle, and Minneapolis are possible good states that will have higher growth. Therefore, the US offices REITs that are stationed in the different regions will make a lot of difference, because it's also further stated in the respective REITs earnings. So in the next video, when we analyze on the 3 US office REITs recent results, we can see if there's any difference in the performance between the different states of the offices. Of course, it's not all good news, with the gross leasing activity actually decreased by 4.2% quarter over quarter. Moreover, it's still negative 35% as compared to the average leasing activity from 2019. So the majority of the leasing activity decreased. As you can see from this paragraph, the US office market is experiencing a 53 million square feet of deficit from the lack of large-scale lease transaction above 100,000 square feet in the past year, as larger transactions were either placed on hold or reconsidered due to macroeconomic challenges. So as the economy improves and the businesses gets more clarity, they might have a better or more confident when it comes to spending money. Hopefully, as the US economy recovers and the CPI data comes in lower and lower, this will give the office or businesses more incentive or more encouragement to actually start spending more money in respect to leasings. In conclusion, I feel that US office REITs are actually still priced at a huge discount, with dividend yields being more than 10%, except for Manulife US Reit, which has actually stopped dividend due to the high leverage ratio. I also like to congratulate those investors that are able to buy these REITs at a very low price. Of course, the fundamentals still play a very big part, and close monitoring must be done. For me, the Manulife US Reit's leverage hit is a one-off event. where Keppel, Pacific Oak and Prime US Reit should not be facing this issue. In my next video, I'll go through the 3 earnings results and see what are the differences in their performance. Thank you so much for watching. Please hit the like, subscribe and support my channel by clicking any of the links below. You can watch my previous videos on the last quarter's earnings results for these 3 respective US REITs. Thank you, and I'll see you in the next video.